All right, welcome back everybody. Now we're going to be moving on to our exercises. So we're going to be doing our chapter 7.4, 7.5, and 7.6. And we're going to be dealing with our perpetual inventory, but we're going to be focusing on mainly sales. Okay, so this is going to be our exercise for today. So here, let's go ahead and dive into our first problem. So it says journalize, and it says assume that sales tax is going to be 8.25%. You purchase a total of 500 cups with all costs equaling up to $1.36 per cup each. Okay, so now we're going to go ahead and dive into our first scenario. So on April 5th, you sold 100 cups. You sold 100 cups at $5 each to customer A for cash. All right. So the first thing that we're going to recognize is what is the transaction at hand? What did we do? We sold cups for cash. So the first thing that we're going to recognize is cash, because we are going to be receiving that from customer A. We also need to recognize our sales, and we also got to recognize our sales tax on that. All right. So let's go ahead and calculate this. We bought 100 items at $5 each, giving us a total of $500 for our sales. We're going to take that number and multiply it by 8.25%, and we're going to get $41.25. So $41.25, giving us a grand total of $541.25. Okay. Now, because we're using perpetual inventory, all right, what is the next thing that we need to include? We need to include the amount that we're going to be taking out of our inventory, which in this case is our cups. Now, first, before you do that, I'm going to recognize that I sold to customer A. All right. And then now I need to make sure that when I do my cost of goods sold, how much stuff am I taking out of inventory? So here I recognize that I sold 100 cups and it cost me $1.36 for each one. So let me see. What are the things that we're going to recognize? Make sure you have the date so then you're keeping all your transactions together. So we know that we need to do our cost of goods sold, and we're taking it straight out of our inventory, which in this case is cups. All right, and sold to customer A. So how do we figure that out? So if we sold 100 items at $1.36, okay, we need to take out 136 items because we sold it, and we need to take it out of our inventory because we no longer have it. All right. Okay, so what happened next? On April 7th, you sold 25 cups at $5 each to customer B on account. You gave him 10%, 15 net 30. Okay, so how do we recognize this transaction? So on the 7th, you allowed him to have an account. So therefore, we need to recognize that we are going to be using accounts receivable. Okay. We also need to recognize that we made a sale, and we need to include the sales tax payable. to say customer B, comma, 10%, comma, 15, comma, net 30, okay? So I'm going to recognize that today on the 7th, I made sure that he has this terms to see if he meets this discount period. So here I'm going to recognize that he purchased. So our sales that he purchased is going to be for 25 cups at $5 each. Okay, which okay, so it's going to be for 125. Okay, so sales is going to be for $125. Okay, we're going to multiply that by the sales tax rate, which is going to give us $10.31. All right, giving us a grand total of $135.31. Okay, so that's our grand total for there. And then for 4-7, we also need to recognize how much we sold. And we need to take it out of our inventory, which is our cups. Okay, so here now we got to recognize how much is 25 cups if we sold it for $1.36 each. And in this case, I get $34. Okay, good. Now scenario on April 10th says you sold 50 cups for $5 for $5 each to customer C for cash. So here again we're going to recognize that we sold our items for cash. So here's cash, here's sales, and we're going to recognize the sales tax payable. All right. And I'm going to also recognize that I sold this to customer C. All right. So we sold 50 items for $5 each. So 50 times $5 is going to give us a grand total of $250 worth of sales. I'm going to multiply that by 8.25%. And we're going to get $20. Oopsies. We're going to get $20.63, which will give us a grand total of $270.63. Okay. Then we're going to recognize how many items we actually sold. So 410. Cost of goods sold. And we're going to take that right out of inventory, which is cups. All right. And we're going to also recognize that we sold to customer C. All right, so 50 items for $1.36 is going to give us $68. So here we recognize that we sold $68 worth of inventory, and I am taking out $68 from our inventory. All right, so next thing that we're going to recognize is on the 15th of April. Customer A returns 10 cups to 10 cups for a full refund. So now we got to recognize this. So we got to first recognize, well, first off, how did customer A pay us? They paid us with cash. Okay, so now we know we have to give them back cash. All right, since sales is finite, sales is the way it is, we're going to create a contra account and name this sales returns and allowances. All right. And of course, with that, we have to give customer A back their sales tax that they paid us. And we're going to give them cash. All right. So let's go ahead and determine if they bought it originally for $10. I mean, if they're originally returning 10 and they bought it for $5 each, 5 times 10 is going to be $50. Then we're going to multiply it by the tax, which is going to give us $4.13, which in total, we're going to refund them $54.13. And I'm going to write here, customer A, full refund on 10 cups. All right. Now, are we done here? No, because customer A is actually returning our inventory back to us, we need to go ahead and put those cups back into the inventory. So I'm going to recognize that I have to add back those 10 cups. So we need to place them back into inventory. And we're going to credit our cost of goods sold. Okay? So again, obviously, in real life, you wouldn't put this back directly into your inventory. Reason being is because you don't know what they did to these items. These items could have been used. They could have been, manipulated with. They could have been dropped. I don't know. There's many things that you can find wrong. So you never want to put it back into the actual inventory. Now, of course, just for the sake of this problem, we don't have a place to put any used or refurbished items. So we're just going to go ahead and make sure that you recognize that whatever happens, you're going to put it back into inventory. And for anything that does happen, you're going to take it out of inventory. So in this case, our inventory is cups. So we're going to put it back into our cups. So here we're recognizing 10 cups, which cost us $1.36. So it's going to be $13.60 that we need to put back to our inventory. All right. And then here, I'm just going to say returned 10 cups. Okay. Do we know? Do we care? No, we're just going to put it back into inventory. So do we need to make it specific to customer A? No, because it's not theirs anymore. It's just going to go back into it. Okay. All we need to recognize is we returned 10 of them. Okay. Let's see what else happened now. Now we are completely done with that transaction. Okay. So April 20th rolls around. Customer C returns 25 cups, but is willing to accept a 15% discount. Okay. So again, how did customer C pay? Let's see. Here on April 10, they paid with cash. So now we know that we have to return via cash. So let's look at this problem again. So he's attempting to return 25 cups to us, but we convinced him somehow to take a 15% discount, and he accepted it. So here we're creating an allowance for this customer. Okay, so I'm going to go here, and it was on for the 20th of April. So April 20th, we're going to recognize sales returns and allowances. Okay, with that, we also have to give him back his sales tax because we no longer are going to sell him that price anymore. So we need to give him back his money that he paid into the sales tax. So, and then lastly, we're going to recognize cash. So let's go ahead and determine the total amount of sales. He wants to return 25 cups, right? And 25 of those cups, all right, we got to figure out the price for that. So we recognize that, let me see. So if he wants to return 25 cups and he originally purchased it for $5, so it gives us a total of $125 of sales. We're only going to give him a 15% discount. So therefore, we're only going to give him his $18.75 back. So here, we're only going to give him his $18.75 back. We also need to multiply this by 8.25% to give us his $1.55. So I'm going to double check that again. So, okay, so if he bought his items if he bought 25 items, all right, and we're multiplying that by 15%, which is $18.75. We're going to remultiply that by the 8.25%, and I get $1.55. 55 cents. So $1.55 plus our 18.75 is going to give us a total of $20.30 back that we have to return to him, to customer C. All right. And then here I'm going to indicate that customer C 15% discount on 25 cups. Okay. So are we done for here, or do we need to put those back into inventory? Okay. Good. There is no need to put back anything in inventory because we convinced him to keep it. So therefore, we do not need to update our inventory because they never gave it back to us. So this is done for this example. Okay. Lastly, we are going, so on the 22nd of April, customer B pays for his purchase and he makes the discount, period. Okay, great. So we remember customer B purchased it here. Okay, so he actually made it perfectly on time for the 15 days, so he made it into the discount period. So we need to recognize it. All right, so he's going to pay us in, I'm going to say, just to make this scenario a lot easier, he paid us with cash. Okay, so that's the first thing that we're going to recognize is he's paying off his debt. Okay, and because he was able to give us a 10% discount, we need to recognize our sales discount. Yes, sales discount. Okay, and then lastly, his accounts receivable. All right. So if we know that, let's by scrolling up at the top, if we know that he owes us for, I believe he made the purchase on the 7th. If we know that customer B owes us a grand total of 135.31, so let's go ahead and put this in here. So he owes us a total of $135.31. However, we're giving him a 10% discount. All right. Now, what number are we going to use? Are we going to use 135.31? No, we're only going to use the original price that he paid for us because you cannot discount tax. So in this case, he originally bought 25 cups for us for $5 each. So the number that we're going to be using is going to be 125. We're going to multiply that by the 10%. So we're looking at a $12.50 discount. Okay? And then we can take it off of the 135.31 to give us a grand total of $122.81 that he's going to pay us. Okay? And then from here, we're going to recognize customer B pays paid. Okay? So here, do we need to do anything towards the inventory? No, because we are giving him a discount of the product that we sold. Okay? We did not get a discount for making those purchase of items. So therefore, we do not have to do anything after this. We do not have to update our inventory because you can't apply a discount on, especially for a sales discount, you can't apply it on something that you purchased. No. So unfortunately, you don't need to update your inventory with this part because the sales does not really affect the portion. It only affects if we actually return something, and in this case, we did not return anything. All we did was give them a sales discount, which does not affect inventory whatsoever. Okay, so you don't need to put a piece back into the inventory. You only need to do it when you're either you're either returning the product 100%, even with a discount here, because we never returned anything, therefore you don't need to update it at all, because in the end, we're not updating our inventory, we're not valuing our inventory any higher, because it's based on what we sold it for. So the selling price is different from the actual purchase price, and these two have nothing to do with them. All right. So that is it for chapters 7.4, 7.5, and 7.6. Exercises dealing with perpetual sales. All right.